Welcome to Talk Tickers, the briefing that drills down past the headlines and gets you right into the heart of the numbers. If you're following the industrial materials sector, you know exactly what we're talking about today. We are taking a deep dive into the confirmed preliminary merger discussions between two absolute giants, Rio Tinto and Glencore. This is not just news. This is a potential event that could fundamentally restructure the entire global mining landscape.
Exactly. We're talking about a truly audacious move. It's something that's been tried before, but it has never felt so, strategically essential. So our mission today is to break down everything we know, the filings, the analyst notes, the market reaction, and really figure out why this deal is happening now, what it means for the world's supply of critical minerals, and what the monumental hurdles are.
Let's unpack this. It's a $260 billion question. Give us the critical snapshot. What did the market officially learn?
Right. So on January 8th and 9th, 2026, both companies confirmed it. They are in active preliminary discussions about a combination of some or maybe all of their businesses. The key word there is confirmed. This is not a rumor anymore.
And if they actually pull this off, the scale is just staggering.
Staggering is absolutely the right word. If this gets finalized, the combined entity would have an enterprise value over $260 billion. And just on market value alone, it's around $207 billion. But the crucial part is that it would immediately displace BHP as the world's largest mining company. They'd become this super titan of the materials sector.
Okay, so let's talk mechanics, because how they structure this deal is critical. The materials we have really emphasize this is an all-share merger, with Rio Tinto as the acquirer.
That's right. And they're structuring it specifically as a court-sanctioned scheme of arrangement. Now, that phrase sounds like a lot of legal jargon, but it's really important. It's a specific UK legal pathway that lets them force a 100% buyout of all Glencore shareholders once they get enough of them to agree. It's cleaner. It avoids having those messy minority shareholders later on.
So Rio is positioning itself as the disciplined one here, using the sophisticated route to lock down the target. And the pressure is already on. Under UK takeover rules, they can't just let this drag on. Rio Tinto is facing a firm put up or shut up deadline, 5:00 p.m., February 5th, 2026. They either have to announce a formal offer or just walk away. That's barely 4 weeks of intense negotiation.
And the market reaction was a perfect case study in M&A psychology. Glencore shares, they just surged up between 8 and 10% almost immediately. Investors are pricing in a really big premium for those copper assets.
And on the flip side, Rio Tinto shares actually retreated. They dropped about 6%. And that signals some pretty deep anxiety from Rio's current shareholders, doesn't it?
Oh, absolutely. That retreat is the market basically saying, okay, we see the logic, but we're terrified of the integration risk, the dilution, and maybe most of all, we're afraid management is going to overpay.
That deadline is tight. But to really get why Rio is moving so fast now, we have to look back a little. This isn't a new idea, is it?
Not at all. Not even close. These two have been talking on and off for the better part of a decade. Glencore even tried to make a move on Rio as recently as late 2024, and it failed. The difference now is the fire that's burning today. And that fire is 100% fueled by copper.
The copper supercycle.
Exactly. The undeniable acceleration of the copper supercycle. We're not just seeing high prices, we're seeing structural deficits emerge. Refined copper deficits are currently sitting somewhere between 150,000 and 330,000 metric tons. The world simply cannot get enough of it right now.
And this isn't just a cyclical thing. This is structural. It's driven by massive new consumers that, didn't really exist at this scale 5 years ago. Think about AI data centers. The amount of copper they need for power, for cooling, it's just enormous. The sources we have show they're projected to consume over 500,000 tons a year on their own. You couple that with a tripling of defense spending, which is incredibly copper intensive, and you see why prices just hit an all-time high of over $13,000 per ton.
And that scarcity is really forcing Rio Tinto's hand. Rio is facing, an existential crisis with its revenue. Historically, 60 to 70% of its earnings, its EBITDA, comes from just one thing, iron ore.
And that's a problem now.
It's a huge problem. That iron ore stream is facing long-term decline for two big reasons. First, the cooling Chinese property sector, which was their main buyer. And second, there's new supply coming online from the Simandou project in Guinea, which is going to flood the market and challenge Rio's position. They have to diversify fast.
So they need to pivot, and aggressively, to the metals that are driving the energy transition. They started with that Arcadium lithium acquisition last year, but that was just dipping a toe in the water.
Right.
Glencore is the whale.
Glencore is absolutely the whale. They have an unparalleled copper growth pipeline. I mean, they're on track to produce 1.6 million tons of copper a year by 2035. For Rio, getting this asset isn't just a nice to have, it's essential for their survival in a world that is rapidly electrifying. The clock is ticking on iron ore's dominance.
And it all fits into this broader industry trend, this mega consolidation we're seeing.
Exactly. We saw it last year with Anglo American and Teck Resources merging. The driver is simple. The era of easy, high-grade deposits is over. The reality is that only the companies with the biggest balance sheets, the true titans, can afford the massive capex to bring these new, difficult projects online. Scale is everything now.
Plus, there was a key change inside Rio Tinto itself.
Right. The new CEO, Simon Trott, who was appointed in August 2025, he's reportedly much more open to these kinds of transformative mega deals than his predecessor. It suggests they're finally willing to take the risk to secure their future.
Okay, so let's dig into the financial fit here, because this is where the synergies are supposed to be. And you can see the contrast just by looking at their commodity mix.
Oh, it's night and day. Glencore has this deeply diversified, almost chaotic profile. You've got copper at about 30% of EBITDA, coal at 20%, zinc around 10-15%, nickel at 8-10%, and then their massive trading business brings in another 20%.
And Rio is
still just dominated by that 60-70% iron ore figure, with copper a distant second at 10-15%. So the combination is truly transformational. You'd be looking at a merged entity that controls something like 1.8 to 2 million tons of annual copper output. That's 8 to 9% of the entire global production.
And analysts are projecting about 800 million in cost synergies.
They are. But that synergy target sounds great on paper. But mining mega mergers are famous for under-delivering.
Right. Is that 800 million number even realistic? Especially with Glencore's aggressive trading DNA versus Rio's more disciplined engineering focus.
That's the billion-dollar question, isn't it? The synergies are mostly operational back-office stuff, but the real unspoken synergy is the stability and access to cheaper capital that Rio's balance sheet gives to Glencore's portfolio.
Which brings us to their balance sheets. Two very different stories.
Very different. Rio runs a fortress balance sheet. They're incredibly disciplined. Their net debt to EBITDA is forecast to be under 0.98x. They're basically risk-free.
And Glencore is the opposite. They run much hotter.
Correct. Glencore has always had an aggressive balance sheet, much higher leverage, historically around 2.3x net debt to EBITDA. So this merger would be a massive benefit for them financially. The combined company would land somewhere in the middle, around 1.57x, which is a huge improvement for Glencore, but it's a fundamental shift in risk tolerance for Rio Tinto.
Okay, now for the hurdles, the massive, undeniable problems. And the biggest one has to be what everyone is calling the coal conundrum.
This is huge. I mean, Rio famously sold its last thermal coal business back in 2018. They positioned themselves as a green leader. They spent years polishing that image. Now, reabsorbing Glencore's absolutely enormous thermal coal portfolio, it's setting off deafening ESG alarms with the very investors who backed that green pivot. It's a huge problem.
So how do they solve it? They want the copper, but they clearly don't want the coal.
The consensus solution being floated is an immediate spinoff. Create a new dedicated Australian coal subsidiary and just spin it off to shareholders. The strategy is basically grab the copper, the cobalt, the zinc, and the trading business, and then isolate the coal problem. That way, Rio keeps its green branding mostly intact.
A neat trick. But that won't solve all the regulatory problems, especially with the geopolitical risk.
Not even close. Antitrust bodies in the EU, the US, Australia, they're all going to be looking very closely at critical minerals security. Copper, obviously, but also things like nickel and cobalt, where this deal creates enormous market power. They might be forced to sell some assets.
And then there's China.
And then there is the truly massive hurdle, China. We have to remember that China's state-owned Chinalco is a major stakeholder in Rio Tinto. The Chinese government is going to be extremely cautious. This new company would have immense concentrated influence over both global iron ore and now global copper pricing.
And there's precedent for China using its regulatory power here.
There is. Back in 2008, Chinese regulators were key in blocking the proposed BHP Rio Tinto deal. They argued it created too much dominance in iron ore. That fear has only grown stronger. If China sees controlling 8 or 9% of global copper as a threat, they absolutely have the power to block this. It's the biggest single risk factor.
Let's shift to the ripple effect. Who wins and who loses from this move, regardless of whether the deal actually happens?
The immediate secondary winner is, without a doubt, Freeport-McMoRan, FCX. They're the biggest publicly traded pure-play copper producer. This mega deal validates a massive scarcity premium for Tier 1 copper assets. Rio paying up for Glencore just proves how valuable FCX's assets are, and the whole sector gets a re-rating.
And on the flip side, the rivals like BHP are now facing a true monster.
They are. Competitors like BHP and Vale suddenly have to deal with a combined entity that has unprecedented scale and pricing power. BHP especially will feel immense pressure to respond, maybe with their own massive acquisition. The arms race for copper has officially gone nuclear.
All right, let's move into our This Is Not Financial Advice segment. I want to hear an outrageous but plausible trade idea based on all this.
Okay. In the spirit of analyzing market dislocation, here it is. The idea is a relative value trade. You go long Freeport-McMoRan, so long FCX, and you go short Rio Tinto, short RIO.
Okay, interesting. A pairs trade. The logic for being long FCX is clear, but why short the acquirer? Why short Rio when they're the ones solving their big strategic problem?
Because the market loves scarcity, but it hates indigestion. We've already established that Rio buying Glencore proves the market has to pay up for Tier 1 copper. That drives FCX higher. So that's our pure play bet on copper scarcity.
Okay.
Conversely, Rio Tinto faces that profound shareholder skepticism we saw in the stock drop. They're facing a triple threat: huge integration risk, a potential culture clash, and the whole pull problem. So whether the deal happens or not by February 5th, Rio faces indigestion risk. The market might just decide they're overpaying. So by betting on copper scarcity through FCX and M&A pain through RIO, you get this robust spread trade that captures the company-specific issues and minimizes the broader market volatility.
That's a high conviction bet. It really captures the fundamental pressures in the industry right now. So what's the key takeaway for you listening at home? I think the strategic logic for this deal is simply undeniable. Scale is the only real defense against volatility in this energy transition. The value in the whole materials sector is shifting away from iron ore and toward critical minerals like copper.
Indeed. And if the super titan is born, its success will depend far less on the merger terms or the premium they pay. It's going to come down to whether they can integrate Rio's disciplined operational focus with Glencore's aggressive trading DNA. That's where these deals usually fail. And here's the final thought for you to mull over. If this deal does go through, does the unprecedented size of this company mean that regulators like China will shift from just blocking deals to actually dictating where the output of these critical minerals has to go? That geopolitical clash, that's the real long-term risk to watch.